What's going on, guys? Welcome back to another video here. So in this one, we have a lot of things to talk about with what was happening with the market today. So we have the overall S&P down again. We did see a little bit of a glimmer of hope in the morning trading session, and then we got shot right back down. And again, in that last trading hour of the day, obviously, we did see some more volatile price action. Now, we have a lot of other things that we need to discuss here too. Morgan Stanley is calling for more significant drops in the market right after Goldman Sachs has done the same thing, signaling that they have gone to mostly cash in this market right now. And we're also going to talk about this concept of TINA too and where this cash could potentially be going. We have some crazy things happening in Europe as well, and we're going to break down this entire situation with the market in this whole update here. So get ready. We have a lot of volatility yet to come. So guys, before we get into all of this information here, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button too and turn on that notification bell so you're notified every time I post a new video. So going into the SPY right here, we're going to be first taking a look at this on the 4-hour time frame. Now, if you watch my video from Saturday, we were talking about the potential for the SPY to start to come up here and do that little bit of a retest of those upside levels. And if it was going to continue, that could have been some elements of a short squeeze or some of these shorts starting to get out of their positions. Maybe not a squeeze per se, but trying to cover off of some of these lows if they had these short-term positions. But if you put this on the 5-minute time frame here, you can see that this short-term rally in the morning got heavily sold into. Now, looking at the 1-day time frame, the daily chart on the SPY here, we are on the brink of another very, very significant cascading sell-off. Now, you could call this a double bottom down here, and we could start moving back to the upside. But what you have to think about as well is, well, why would institutional investors, the players in the market who are moving it, come back into the market now and start buying assets, especially when there are alternative places to put your money into right now? Inflation's still very high. We have not seen the things that we need to see overall in the overall economy starting to come back into these normal levels. We are not out of the woods yet, and we probably won't be for some time. But again, if you guys were with us today, especially on the streams, there was a lot of money to be made. And I first want to highlight here the proprietary trading algorithm Trader Joe, who is up about 38% since inception. Now, if you look at what the market has done this year, it's been absolutely chaotic and volatile. Our trading algorithms, there's nothing else like it on the market right now. They are super, super powerful. We have Trader Joe that trades on the daily time frame with 1348, Pythagoras, the predictive algorithm, Invictus, the predictive algorithm that trades on the 5-minute or alerts on the 5-minute. If you guys are interested in all of the amazing things that we have to offer and that are coming down in the pipeline, make sure you guys check out that link down below. It's the best place to come and learn how to trade. Our community is growing very fast. We have a lot of people finally seeing that, wow, the market is an awesome place to make money. So if you guys are interested, check out that link down below. But we also have this situation with the dollar right now. Now, I have heard a couple of things from some people, some statements from talking heads on Twitter that the dollar is in a little bit of a bubble right now. But what you have to think about is, well, if you are still seeing inflation at relatively high levels and it still needs to come down, that is going to increase the value of the dollar. Rate hikes are going to do the same thing, increasing the value of the dollar as well. And when you tie in all of the different foreign currency and foreign exchange nonsense going on right now with the yen, the pound, well, it makes sense that the dollar would continue to rise. The other thing that we need to talk about here is the 10-year treasury yield. Now, there were 2 instances today where the 10-year treasury yield flashed above 390. Now, the first time that it did this, it came right back down. Now, what that would signify to you is that if you're looking at yields here, well, if yields are shooting up and then coming right back down, that movement to the downside would signal that institutional investors are buying bonds. This brings us back to the concept of TINA. There is no alternative, because remember, over the last, let's say 10 years, if we throw this on even the monthly time frame here, the 10-year treasury yield has been on this very, very significant downtrend and has finally broken out of this trend. With yields coming down like this, nobody really wants to be holding bonds for the cash flow that they're going to receive. Now, though, it's a different game. We have not been this high in terms of the treasury yields since 2010. So we have this situation right now, and you think about overall supply and demand in the market. Well, if you can then go towards a less risky or essentially risk-free asset getting right now around 3.9%, well, that makes a little bit more sense than putting your money into the risky and volatile stock market here. And that's most likely what we're going to see a lot of these big institutional investors start to do. Morgan Stanley, ticker symbol MS, can you hear me now? It appears investors have finally gotten the message with a Fed pivot now undeniably off the table. Now, what the pivot would be is slowing down the rate of rate increases or even the runoff of the balance sheet. We are not seeing the data that we need to see right now in order to give the Fed the ability to start slowing things down in terms of their tightening measures. We remain highly convicted the bear market in stocks will not be over until the SP 500 reaches a range of 3,000 to 3,400. That is some more significant downside that we could be seeing there. But even then, once we get there, it doesn't necessarily make a whole lot of sense to, one, go all in. It doesn't make sense to do that in really any regard or any time period. But starting to drip in some money at those levels could be smart. Now, when you think about the market right now, you're going to hear a lot of different opinions, and I want to kind of harp on this comment again from either YouTubers or people on Twitter or maybe even somebody on CNBC, such as Jim Cramer, that we could be in for a bounce. That bounce does not mean that the market is reversing back to the upside. That bounce is short-term relief of potentially unhedging of derivatives positions, of some shorts starting to slowly get out of some of these hedging positions. When you think about the main reasons for buyers to step into the market, we need a light at the end of the tunnel from the Fed and everything going on in the global economy right now, and we have not gotten that yet, and it doesn't necessarily look like we're going to get that for some time. Now, again, Morgan Stanley right here, the Morgan Stanley strategist who called the bear market says the S&P could fall to the low 3,000s. Reiterated right here, this is where we're getting this information from. And again, when we come over and kind of take a look at what's going on in these foreign currency markets here too, well, there was a very interesting situation that was happening this weekend with the British pound. Nomura sees British pound below parity with the US dollar by year end. The British pound sterling has weakened 20% against the US dollar year to date, bringing the currency's value to 1.08 on Monday, and Nomura analyst Jordan Rochester expects the pound to fall below parity by the end of the year. The pound is down 0.4% Monday morning, trading in fell as low as 1.05 in response to the new UK government budget introduced last week that cut taxes and increases spending. That doesn't seem like that's what we need to be doing right now in an overall worldwide inflationary environment. This is a fundamental balance of payments crisis, with politicians hoping it will eventually calm down. Hope is not a strategy, and the markets are reflecting that. Now, if you guys watched the video from this past weekend, we were talking about the potential for an emergency rate hike from the Bank of England to actually come in. Now, we didn't get that today after the comments here, and we can actually start taking a look at some of these comments. Let me see. This is the one right here. The bank is monitoring developments in financial markets very closely in light of the significant repricing of financial assets that literally everybody and their mother saw coming. In recent weeks, the government has made a number of important announcements. The government's energy price guarantee will reduce near-term peak in inflation. Maybe, maybe not. Last Friday, the government announced its growth plan, on which the chancellor has provided further detail in his statement today. I welcome the government's commitment to sustainable and economic growth and to the role of the Office for Budget Responsibility and Assessment for prospects for the economy and public finances. Now, in general here, it will make a full assessment at its next scheduled meeting on the impact on demand and inflation from the government's announcements and the fall in the sterling, and to act accordingly. So they didn't make a comment on the pound today, which was very, very interesting. There were a lot of people coming out and saying that an emergency rate hike could be coming. Now, with the way that this whole situation is set up right now, there's a lot of different moving parts. You see the bond market freaking out, the stock market freaking out, commodities, oil, natural gas freaking out as well. And all of these things are kind of going to be moving in tandem over here and in a circle. You're going to see bonds start to move, the dollar start to move, the US equity market start to move. You see the effects of rate hikes affecting foreign currencies here. So there's a lot to look at in order to get a good picture of the market. But in order to simplify all of this back down, because I know a lot of this information can be overwhelming, the way that I want everybody to be thinking about this is, what is the catalyst for buyers to come back in? And it's light at the end of the tunnel. And thinking about the other things that are actually coming out, you can boil this down very simply. Are the things coming out helping the inflationary problem and getting growth back on track to normal levels, or is it hurting? most of the things that we're seeing right now are hurting almost everything happening in every single market. We haven't even seen the effects of the real estate market sell-off that is going to be coming due to the increases in mortgage rates that we've seen over the last 6 to 8 months. So again, this situation is going to take a lot of time to play out, and I personally do not think that we have reached the market lows yet, and I would sort of agree with some of those larger financial institutions that we could see that bottom right around 3,300 to around 3,000. Now, when are we going to get there? Well, it's hard to say. We are going into this election time frame here, and I don't want you guys to think about, well, this could happen tomorrow, this could happen next week. Again, we're most likely going to see these drastic sell-offs, some of these relief balances, a little bit of consolidation before we start to make those moves back lower. But again, guys, in general, the market is not looking so hot. We have a lot of problems that need to get resolved before we can get back to that exuberance that we were seeing back in 2020 and 2021. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great day today. There was a lot of money to be made. I'll see you guys in the next one. Peace.